There's no sign of identity theft slowing down. And why should it? More than $29 billion were stolen from identity theft victims last year alone. To cybercriminals, it's a success story. To the rest of us, it's a wake-up call. Your personal info is in more places now than ever. And all that exposure can make it dangerously easy to steal your identity. LifeLock makes it easy to help protect yourself by monitoring your identity and alerting you to threats you could miss on your own. And if you do become a victim of identity theft, a U.S.-based LifeLock restoration specialist will be dedicated to your case and will work to fix it. Don't wait to get LifeLock identity theft protection. Join now and save up to 25% off your first year. Go to LifeLock.com/ACAST. That's LifeLock.com/ACAST to save 25% your first year. LifeLock. Identity theft protection starts here.
Stocks for Beginners. Weekend Watchlist.
Hi and welcome back to Stocks for Beginners Weekend Watchlist, where we take a close look at an individual company, sector or ETF that you may wish to consider for your watchlist. It's not a recommendation to buy, but a way for you to learn how experts screen for value and opportunities. And joining me today is Anirban Mahanti from 7 Investing. Hello, Anirban.
Hello, Phil. How are you?
Good. Now, I believe you've got a very interesting, well, you said it was interesting, but boring company, very small company. It's called TaskUs, and it's an IT outsource company. Tell us about TaskUs and what kind of company it is and what it does.
Yeah, so as I was telling you, it's a bit boring because it's an IT outsourcing company. It's not exciting. It's not software, services. It's not electric vehicles. It's not sending rockets to the space or anything. It's just doing boring stuff for other companies in many ways, stuff that other companies don't want to do.
But does it generate revenue? That's not boring.
That's the thing. That's exactly. So that's why it is. It's interesting at the same time because it's growing really quickly. It's profitable, and it's got I would call it class leading margins in its if you call it business process outsourcing or IT services sector. So to give you a quick overview of what they do, so they are they provide. I'll give some examples. So, for example, if you are Uber and you need to sign up drivers, right, then you need to do some checks on those drivers and see all those forms that you request are filled properly. They have a proper driver's license, and so this is like knowing the contractor that's being hired, right? Or if you're a crypto exchange and you have new accounts being opened very quickly, at a rapid pace, people are just joining and they want to trade crypto. Now, I'm not saying you should do that, but people are doing this. Then you want to know your customer, right? So then, for most fintechs, that's important. If you're a fintech and you're serving customers, knowing your customers is a government regulation or requirement in most jurisdictions. So these are things that the fintech company might not want to do, because it's not really, they're a fintech company is basically a tech company and their focus is on tech. So they would like to outsource these sort of things. Or you think about customer support, right? So if you want to provide digital customer support, how do you, sometimes you need to talk to a real person. How does that happen? If you're talking to a chatbot, the chatbot then transfers it over to a real person. How do you manage that sort of transaction? If you're Facebook, which is actually this company's largest client, then you have, what's known as content security, which is, is this a fake posting? Is this spreading rumors? Is it, causing harm? Those actually need to be manually reviewed, right? So there's automation that you can do. And then after automation, maybe things are flagged by automation. You need then some reviews for those things to happen. So TaskUs basically facilitates all those things. I'll give one more example. So the company runs 3 segments. One is digital experience, which is really providing support and to digital companies, right, of various forms, whether it is in-person support or supporting your customers and things like that. So that it does for fintechs, Uber, and so many others. All these are clients of actually of this company. Then you have what is known as content security, which is really helping social media manage the content that gets posted, right? So they actually serve all the top social media, or most of the top social media companies. And as I mentioned, Facebook is their largest client. Then they have an operation called AI services, which looks at, things like if you're a autonomous driving company, you're collecting all this data. That data needs labeling. Some of that data labeling can happen autonomously or via algorithms. in some cases you need manual intervention, or you need at least people to supervise and check what's going on. So again, those sort of things, as an example, is what they provide under AI operations.
I hate using cliches, but this sounds like what they'd call a picks and shovels company. Would that be a valid description?
There's a very, very valid description. You just stole my words. I was looking for those words. Yes, it is picks and shovels. It's a picks and shovels with, I will put a caveat on it. It's a picks and shovels for tech. Really, all their customers are high tech. So, whether it's Facebook or Netflix or, people like, DoorDash, they are their customers, right? So it's picks and shovels for the tech companies. So if you assume the tech companies are going to keep growing, then the picks and shovels for the tech companies as a whole sector should also grow, and this company should benefit. So yes, brilliant. I love it, Phil.
And the other thing about it is, are these solutions that they're providing, are these bespoke solutions for every single case? Or when you described those three major areas before, are they kind of like general solutions that can be tailor-made for each of their customers?
So that's a good question. I don't have a good answer for it, in the sense that the way the company works is that they get asked to do a specific task. That's how they enter a relationship with a company. And then over time, that relationship expands to doing other things. So it is bespoke in the sense that it is tailored for individual companies' needs. But they have underlying tools and technology that they use to sort of automate their processes and to make things as seamless as possible. Of course, this being an IT outsourcing company, right? Most of their staff is actually, their largest amount of staff is in Philippines, followed by India. They have staff in the United States as well. So I would guess that the staff in the United States is doing some more heavy lifting stuff, maybe more sort of the cutting edge of machine learning, for example, whereas the staff elsewhere might be doing more manual work, right? Because it's, the labor would be cheaper. So it is bespoke to that extent, but there's some underlying tech and stuff that they're using. But it is IT services, or you can even call it business process outsourcing to some of those things, right? So, yes.
Yep. And it's a very small company. The capitalization is very small. Run us through some of the numbers, please.
Yeah, so the market capitalization, actually the stock has dropped a fair bit from, maybe in the last 6 months. It was subject of a short attack, saying that, this company is not going to grow and some of these numbers are made up, they're related party transactions. I think, a lot of those things are... I don't see much merit in the short attack. The company is growing quickly. Now, one of the things, so this is where the caveats come into play, right? So revenue, for example, this last quarter, in the fourth quarter, grew about 63% to about $200 million, $226 million, $227 million. And its EBITDA margin was about 24.7%, which is really class leading in, if you think about the BPO and the IT services sector. Revenue retention rate, which is basically how much revenue they're extracting from clients that they're retaining, was 141%, which means they're growing the sales to the clients that they keep, right? Which is all great. Now, the reason I'm saying there's a caveat to this is, like Facebook is the largest client, accounts for about 25% of the revenues in Q4. And the Facebook has basically come back and asked them that, they're probably asking them to do some optimization in the spend. So it looks like the majority of the Facebook spend was in the United States, therefore higher revenue. Facebook wants to get more bang for its buck, or Meta, I should say. So they're basically out asking them to move some of those or majority of those to Philippines and India. And in return, because they're paying them, so they probably don't want the revenue to go backwards, they want more work to be done by these guys. So they're giving them more work, which probably is going to be done in other remote locations. So what happens is revenue growth can slow down, but margins can still go up, because one would assume, or at least what management thinks or says, that margins are higher overseas than they are locally in the United States for them, right? So the company is growing quickly. It's projecting 50% growth in the first quarter, but projecting for the full year of 2022 about 30% growth in the midpoint, and even that is pretty solid. It's profitable, cash generative company. And the reason I think there's that drop is they are moving that Facebook client over Q2, Q3, and Q4 to Philippines and India, or other lower cost regimes. But that's something to keep in mind. But yeah, it's a profitable company at a good price.
Listeners know that I'm always banging on about diversification, and that doesn't mean buying different stocks. Diversification means being invested in a range of asset classes like bonds, real estate, precious metals, and now wine. Wine is an asset class that's been around for hundreds of years, but until now only available to the mega wealthy. VinoVest makes it easy to invest in wine. They have a team of world-class sommeliers who evaluate wine and determine which ones will gain value over time. You own the wines in your portfolio outright. You can buy, sell, and even drink them whenever you want. There's a case of wine in a warehouse with your name on it. Wine has a third of the volatility of the stock market and has outperformed global equities over the past 30 years, with 10.6% annualised returns, proving that the returns can be as full-bodied as your favourite Napa cab. Go to zen.ai/stocks for beginners to receive 2 months of fee-free investing. Be sure to mention that Stocks for Beginners is helping you save on 2 months of management fees. It's time to start investing with VinoVest today. That's zen.ai/stocks for beginners.
Over 4 decades, Aberdeen has built deep relationships throughout emerging market economies. And each episode of our Emerging Markets Equity podcast is your chance to eavesdrop on an agenda-setting conversation between me, Nick Robinson, and some of our brightest minds, figuring out the opportunities in key emerging markets. Search for the Emerging Markets Equity podcast from Aberdeen. That's ABRDN, wherever you get your podcasts.
You mentioned the short attack. That's an interesting... Do you mind if we just dwell on that just for a moment? What is a short attack? I mean, from my limited knowledge, it's like an analyst comes out and identifies a whole bunch of problems with a company and then starts to short sell it, which means they're going to make money as the price goes down. Just give us your overview of what a short attack is and what this specific case was.
Yes. So a short attack, really, I mean, you described it already, but, I'd pivot it a little bit. So a short attack would be if I am a fund or a hedge fund or a private fund or whatever, big investor. I don't like a company. Well, I've done my research. I don't like a company. So first, I sell short, which basically means I borrow stock on the market and I sell it. Now, I took stock from someone else for which I'll pay small interest because I'm borrowing, and I sell it in the market. And then I release my report. They will never release a report beforehand, right? So they will never tell everyone that, oh, this company has got problems, don't buy it. It's rather, we have sold short the stock. I borrowed somebody's stock. I've sold it in the market, release the report, want the price to go down. And then when the price goes down, they can buy the stock for lower price in the market and then give it back to the person that they borrowed it from, or the persons or the people. Most of the time, what they're using is brokerages. Brokerages basically would lend your stock to somebody else to sell. But the brokerages would then demand that the stock be returned back to them if they ask for it, right? And when they demand basically means buying it back in the market. So that's what it is. I mean, it's a practice I'm not a big fan of because, if you look at the modality really is the report is released. I don't have a problem with the criticism of a stock being released, but it is often always released, 99.99% of the time, released after the fact, after they have shorted the stock, which means they already have a vested interest, right? Now, one could, of course, go back and say, well, there's the same thing for people to say, I own the stock and it's great, right? Or this stock is great. Well, later on, you find out they own it. It's a similar dynamic, but we also
and they pump it,
they pump it. But one of the things that human psychology comes into play, right? A stock shouldn't drop so much, 30%, 40% on a short attack, but it does. Stock does not go up 30% because I tell you I own it, right? And the reason behind that is fear drives people's behavior more than, the potential of loss is always felt much more strongly than the potential of gain. So the stock might go up 5% on some big investor, if Warren Buffett comes out and says, I own some company, it might go up 5%, right? At least on that news. A maximum. It might even do nothing. They might think, oh, Warren Buffett is a done investor, so we don't care. Maybe it should go down, right? As an example. I'm not saying that's it, but I'm just using that as an example. But if Warren Buffett says I'm short on some company, I bet that stock is going to collapse 40%. So that's, I think, the part I don't agree with shorting. But anyways, it's happening. The short interest is not that high. So it looks like, at least I recently checked, and if the data is correct, short interest is the percentage of shares that are held short of the total float.
Yep.
So that's not that high, which suggests to me that it might have been short covered, which basically means they bought it back.
And this is basically an opportunity to talk about the risks of the company. And did this short attack identify solid risks, or are there other risks that you see as well?
Well, I don't think so. So they had a number of things that they pointed out, which, they pointed out some characterization of the CEO's education, which looked like, there's a mismatch between what's said on the IR website and what's said on LinkedIn. I don't really care for those things that much, largely because, as a person have
really, they sound like spurious accusations, really, don't they?
It's a little bit spurious, yeah. I mean, the thing to note, though, it's IT outsourcing, right? So it's outsourcing. Somebody else can take your, lunch and breakfast and run with it. In many ways, there's no moat as such, right? And that's a valid acquisition. At the same time, but it's not really an acquisition, it's a fact of that business. But at the same time, you look at the clientele and the fact that clients are spending more money with you, then there is something to it. The other thing is that all the growth of this company has had is organic, right? Which is pretty solid for an area like this. And so I don't think that, I thought they were pretty weak in terms of like the short attack was weak in terms of what it does. But again, there are certain patterns that people look at. So this has got a small float, which means the percentage of shares available to general public is small, largely because it's a recent IPO. Blackstone owns a chunk of the company because they bought a private stake in it 3 years ago. And that infusion actually helped them grow. And then the founders own close to 25% of the company, the two founders. So that's, again, very rare in the American market for the founders to own that big a stake in a business, right? I mean, they've got their wealth tied up and they've got their reputation tied up with this business. So I still like it. I think it's great. I personally own the stock. I think the price is great. It's only about 27 times earnings, maybe 26 times earnings for earnings that grew, a lot, last year. And it's probably, even if the revenue grows 30%, the earnings can actually grow at a much faster pace, largely because of leverage, operating leverage in the business. It's got. So yeah, I like it, and I like it for those reasons.
And what's the code? And it's listed on the NasDaq, I believe.
It's listed on NasDaq. The code is TASK, TASK.
That's great. Anything else you wanted to add just before we wrap it up?
No, I would just say that, put it on your watch list. Be mindful. It's a small company. It's higher risk. It's IT outsourcing. Mindful of concentration risk, right? So they've got their top 10 accounts for a huge chunk of their revenue. And if everyone starts doing what Facebook has asked for, then it might be a bit of a trouble, right? Those are obvious risks to think about. At the same time, you could say that if you've got high quality clients using your services, that says something about your services and what you offer to the clients.
And it's important to think about, if you are thinking about the risk of investing in a small company at this end of the market, that allocation, the capital allocation, the amount of your portfolio that you allocate should always be absolutely tiny percentage-wise.
Yes, you're right about that. So, I mean, I didn't want to specifically talk about allocation because that, we're
not recommending.
We're not recommending to buy. So whether it's one,
just saying,
this is
something to think about.
Something to think about. But you're absolutely right. Personally, I own it, as I said, but it's not even in my top 15. Largely because, again, for all those reasons, right? It's a small company. If it is a multi-bagger, if it goes up 10x, then it will become a big push. And this is one of the things that I try to keep telling people. If you buy a small company, the whole reason you're buying it is that you think it's going to become big. Then you should only need a small position, because the small positions should grow into a large position over time. And remember, you can always add on execution. And as the company, becomes de-risks itself, yes, you're buying at a higher price, but you're de-risking yourself as well. And that's the smart thing to do. And so I absolutely agree to think about allocation if you are, considering. Yeah, but put it on your watch list. Just, it's, you call it watch list for a reason. And I think it's a good company to have on your watch list.
That's right. Just have a look at it and see how. Learn from watching.
Yes, learn from watching.
Anaban Mahanti, thank you very much for joining me.
Thank you.
If you found this podcast helpful, please tell a friend, especially if it's someone who needs to start thinking about investing for their future. You'll be helping them and helping me to keep this show on the road.
Stocks for Beginners is for information and educational purposes only. It isn't financial advice, and you shouldn't buy or sell any investments based on what you've heard here. Any opinion or commentary is the view of the speaker only, not Stocks for Beginners. This podcast doesn't replace professional advice regarding your personal financial needs, circumstances, or current situation.
And thank you for listening to my podcast. And don't forget, if you want to hear these and other great tips from 7 Investing, go to 7investing.com and use the promo code Stocks for Beginners for a $10 discount on one of their plans. That's Stocks for Beginners, all lowercase and one word.
Over 4 decades, Aberdeen has built deep relationships throughout emerging market economies. And each episode of our Emerging Markets Equity podcast is your chance to eavesdrop on an agenda-setting conversation between me, Nick Robinson, and some of our brightest minds, figuring out the opportunities in key emerging markets. Search for the Emerging Markets Equity podcast from Aberdeen, that's ABRDN, wherever you get your podcasts.